Yesterday, Elon Musk became, on paper, one of the richest humans in history, and almost nobody is talking about the real story. SpaceX didn't just go public. It opened at $135 and rose 19% on its first day, closing at $160.95, valuing the company above $2 trillion. That's bigger than Tesla. On day one. But here's the part most retail traders missed completely. This IPO landed in the middle of an oil shock, a bond market swing, and a possible Middle East peace deal, all happening at the exact same time. And that timing tells you everything about where smart money is positioning right now. Stick around, because the SpaceX story is actually the smallest part of today's picture. SpaceX, the numbers behind the headline. Let's break down what actually happened. SpaceX sold over 555 million shares at $135, raising roughly $75 billion. The biggest IPO ever, more than double Saudi Aramco's previous record. The valuation, $1.75 trillion. For context, SpaceX's 2025 revenue rose 33% to $18.7 billion, but the company posted a net loss of $4.9 billion. That valuation is roughly 95 times annual sales. Compare that to most profitable mega-caps trading at 20 to 30 times sales, and you start to see why some analysts are nervous. In fact, Morningstar called SpaceX significantly overvalued at the offer price. And history backs some caution here too. IPOs from 2012 to 2021 averaged a 23.6% first-day gain, but the average three-year return was only 10.6%. Huge pops often fade. What most people don't know is the ripple effect. This wasn't isolated. EchoStar, which owns about 3% of SpaceX, surged 11% the day before, with options volume more than 11 times its average. AST SpaceMobile jumped 12% on the same news. If you're looking for SpaceX-adjacent plays, these satellite and space infrastructure names are now trading as a basket, moving together on SPCX sentiment. That's a tradable theme on its own. The bigger story, oil and the Strait of Hormuz. Here's what was actually moving global markets this week, and it's not SpaceX. Iran reportedly halted talks with the U.S. and threatened to fully close the Strait of Hormuz, sending WTI crude up nearly 6% to $92.54 and Brent up over 4% to $97.79 just days ago. But, and this is the open loop, by Thursday, everything flipped. Treasury yields fell sharply, with the 10-year down as much as 8 basis points after Trump called off plans for fresh strikes on Iran. Reports emerged of a draft 14-point agreement that would reopen the Strait of Hormuz and lift oil sanctions. This morning, that optimism is still running. Crude fell another 2% to near $85 a barrel on hopes a peace deal is close, though major indexes are still down for the month on rate hike worries. Before you skip ahead, this single geopolitical headline is currently the biggest swing factor for almost every asset class today. Oil, gold, bonds, equities, they're all reacting to the same Iran story. If you trade nothing else this week, watch that headline risk. Equities, UK, US, and Europe. Now let's get tactical. This morning's session is broadly green, driven by that peace deal optimism. In the US, stocks extended yesterday's gains and are tracking for a positive week on the peace deal hopes, though Wall Street wavered on conflicting reports about timing. In the UK, the FTSE 100 is up around 1.6% to roughly 10,471, a strong move for an index that often lags. Europe is even stronger. The DAX is up about 1.76% to roughly 24,635, and the CAC 40 is up around 1.83% to 8,350. The whole Euro Stoxx 50 is up over 2%. Here's the actionable bit. When oil-driven fear unwinds this fast, the biggest beneficiaries are typically energy-importing economies and industrials. UBS has already flagged industrials, IT, and utilities as their preferred FTSE sectors for exactly this kind of recovery scenario, and they've also upgraded European banks. Worth a watch list add if you're trading UK or European indices this week. One thing to watch closely, though, Supermicro dropped 12% after announcing $7 billion in equity financing, following massive capital raises from Alphabet at $85 billion and Meta. Big tech is raising enormous amounts of cash for AI infrastructure, and the market is starting to question dilution. That's a theme that could spread to other AI capex names. Commodities, gold, oil, and the inflation problem. This is where it gets genuinely interesting, and most channels aren't covering it properly. Gold dropped to around $4,080 an ounce, its lowest since November 2025, after U.S. producer prices surged 6.5% year-over-year in May, the highest since November 2022. That's well above forecasts. Normally, rising inflation is good for gold. Not this time. Why? Because the European Central Bank raised rates for the first time since 2023 and upgraded its inflation forecasts, and traders now think the Fed could follow with a hike of its own. Higher rate expectations are crushing gold even as inflation data comes in hot. But here's the surprising part. This morning, gold eased back below $4,200 but held most of its recent gains as growing optimism over the US-Iran deal eased fears of persistent inflation and rate hikes. So gold is now caught between two forces, a possible Fed hike pulling it down, and any reversal in the Iran peace narrative potentially sending it straight back up as a safe haven. That tug-of-war makes gold one of the most reactive assets to headlines this week, both directions. On oil, the range to watch is roughly $85 to $98 on Brent, depending on how the Iran story develops. Every headline swing here is currently worth several percent. Bonds and treasuries. The quiet story. Subscribe now if you want this kind of breakdown daily, because what's happening in bonds right now is the clearest signal in the entire market, and almost nobody's watching it. The 10-year Treasury yield fell more than 8 basis points to 4.489%, the 2-year dropped to 4.04%, and the 30-year fell to 5.024% as peace deal hopes built earlier this week. Then yields slid even further on Thursday as the draft agreement details emerged. Here's the actionable insight. Every time a Middle East de-escalation headline drops, yields fall and bond prices rise, meaning long-duration bond ETFs like TLT-style products get an immediate pop. Every time the deal looks like it's collapsing, yields spike back up. If you're trading bonds this week, you're essentially trading the Iran headline cycle, full stop. And don't forget the inflation angle from the last section. That 6.5% PPI print is strengthening calls for a Fed rate hike in 2026. If the peace deal falls apart and oil spikes again, you get the worst combination for bonds. Inflation fears plus geopolitical risk premium, both pushing yields higher at once. Section 6. What this all means going into next week. Pulling this together. SpaceX's IPO was the headline, but it's largely a standalone story. Exciting, historic, but contained to space and satellite names. The real driver of every market you trade, UK and US equities, European indices, gold, oil, and treasuries, is one single thread. Whether the US and Iran actually sign that 14-point deal. If it happens, expect oil to keep falling toward the low $80s, equities to keep grinding higher, yields to ease, and gold to stay under pressure. If it collapses, expect the exact opposite, fast, across every asset class simultaneously. That's not a forecast, it's a map of the binary outcome sitting in front of markets right now. Trade the headline, not your hopes. See you next time. Follow for a fresh market briefing every single day. This content is for educational and informational purposes only. It does not constitute financial advice. Always do your own research before making any trading or investment decision.